Most people are losing this game by playing it the wrong way, not because they are unintelligent, not because they lack access to information, but because they believe, completely, sincerely, and expensively, that winning requires complexity. They believe that the more they analyze, the more they trade, the more strategies they stack on top of each other, the closer they get to the result they want. I have spent more than 75 years in this business. I have sat across the table from the most sophisticated investors on this planet, hedge fund managers, quantitative analysts, Nobel Prize winners in economics, men who built the mathematics of modern finance. And I want to tell you something that most of them would not want me to say in public. The simple strategy beats them. Almost every single time. Not because simple is easy, but because simple is correct. I call this the complexity trap. Most of you watching this right now are inside it. You do not know it yet. And the cost of not understanding this, the real compounding decades-long cost, is the difference between building genuine lasting wealth and spending your entire financial life running on a very expensive treadmill that never moves you a single inch forward. Let us begin. I want to start the way I always start, not with a promise, but with a fact. In any given year, approximately 80 to 90% of actively managed mutual funds underperform the S&P 500 index. Those are not small operations. Those are funds run by teams of analysts with advanced degrees, Bloomberg terminals, access to corporate management, proprietary research, and decades of combined experience. They are outworked by an index fund that does nothing, except hold every stock in the market and wait. Over 10 years, the underperformance number climbs even higher. Over 20 years, it becomes nearly universal. The people with the most resources, the most intelligence, the most tools, are losing to a strategy that requires no decisions, no predictions, no analysis, and no skill whatsoever. When I saw that pattern early in my career, I did not dismiss it. I studied it, and what I found changed the way I think about nearly everything in finance. The enemy of wealth is not ignorance. The enemy of wealth is the illusion of sophistication. Here is what I want you to understand about why this happens. The financial industry is not built to make you wealthy. I want to say that clearly and without apology, because it is the most important structural truth in personal finance. The financial industry is built to generate fees, and fees require activity. Activity requires complexity. Complexity requires experts, and experts require your trust, your money, and your ongoing belief that without them, you would be lost. This is what I call the noise machine. It is a perfectly designed system, not a conspiracy, not a fraud, but a system that profits from your participation regardless of your results. Every trade generates a commission. Every managed fund charges an annual expense ratio. Every financial advisor charges a fee for the privilege of underperforming the market on your behalf. And what does the S&P 500 index fund charge you? In some cases, 0.03% per year, 3 cents on every $100. The noise machine is not trying to hurt you. It is simply not designed to help you. And the first step toward beating the market is understanding that the loudest voices in finance have the strongest financial incentive to make you believe that silence and simplicity are dangerous. Let me tell you about what I call the activity tax. In 1984, I gave a speech at Columbia Business School. I laid out the track records of a group of investors who had all learned their craft from my mentor, Benjamin Graham. These were investors scattered across the country, managing different assets, using different specific methods, with no coordination between them. And virtually every single one of them had beaten the market over decades. I presented this not as coincidence, but as evidence. Evidence that a coherent, disciplined philosophy, not activity, not trading, not complexity, was the source of their outperformance. The activity tax is what you pay every time you do something unnecessary. Every time you sell a good business because the price dropped temporarily. Every time you buy something because a headline excited you. Every time you rebalance out of fear instead of logic. Each of those actions has a cost. Sometimes it is a commission. Sometimes it is a tax on realized gains. Sometimes it is simply the opportunity cost of being out of the market during the moments when the market does its most important work. Charlie Munger, my partner of more than 50 years, once said that the big money is not in the buying and the selling, it is in the waiting. He was not being clever. He was describing mathematics. The mathematics of compound interest rewards stillness almost as much as it rewards correctness. Now I want to talk about the mirror test. And this is the lesson that most people find the most uncomfortable, because it requires genuine honesty about something we all resist examining: ourselves. Most investors do not underperform the market because they pick the wrong stocks. They underperform because they pick the right stocks and then panic out of them at exactly the wrong moment. A study by Dalbar, which has tracked investor behavior in the United States for more than 3 decades, consistently shows that the average equity mutual fund investor earns significantly less than the fund itself earns. In some years, the gap is 3% annually. In years of high volatility, it is far wider. How is that possible? How does an investor earn less than the fund they are invested in? Because they buy after prices rise, when optimism is high and prices are expensive. And they sell after prices fall, when fear is high and prices are cheap. They do the opposite of what the mathematics requires. They let emotion override instruction. The mirror test is the most important investment test you will ever take, and it has nothing to do with the market. It has everything to do with whether you can look at a portfolio that has dropped 30% and hold it, without flinching, without selling, without calling your broker in a panic at midnight, because you understand that the price going down does not change the value of what you own. Most people fail the mirror test, not because they are weak, but because nobody ever taught them that temperament is more valuable than intelligence in this business. I have said this many times, and I will say it again here. The most important quality for an investor is not intellect. It is the right temperament, the ability to neither be swept up in enthusiasm when prices rise, nor paralyzed by fear when prices fall. Let me now tell you about the patience premium. There is a reason compounding is the only concept in finance I have ever called magical. It is because it behaves like magic to anyone who does not understand the mathematics of time. If you invested $10,000 in an S&P 500 index fund in 1990 and did absolutely nothing, no trades, no rebalancing, no clever repositioning, you would have approximately $200,000 today, 20 times your original investment, from doing nothing, from making one decision and refusing to unmake it for 35 years. The patience premium is the return that the market pays you, specifically for your willingness to sit still while everyone around you is moving frantically. It is not a reward for intelligence. It is not a reward for effort. It is a reward for discipline. And the cruel irony of the financial industry is that the people who collect the patience premium the most reliably are the people who use its services the least. The market does not reward participation. It rewards commitment. Now, I want to address the objection I know is forming in your mind right now, because I have heard it thousands of times. You are thinking, Warren, this sounds simple, but surely professionals with their resources, their data, their algorithms must have some edge I do not have access to. Surely the complexity is worth something. And I understand that instinct. It feels logical. It feels like it should be true. But let me give you a number. Between 2008 and 2017, I made $1 million public bet with the hedge fund industry. I bet that a simple, no-fee S&P 500 index fund would outperform a hand-selected portfolio of hedge funds over 10 years. The hedge fund industry, which charges enormous fees, employs thousands of the smartest financial minds in the world, and has access to every tool, every model, every data set available, accepted my challenge. At the end of 10 years, the index fund returned 125%. The average of the hedge fund portfolio returned 36%. I donated the winnings to charity. I was not trying to humiliate anyone. I was trying to demonstrate with real money and real time a truth that I had understood for decades. The simple strategy does not occasionally beat the complex one. It beats it systematically, reliably, and with a consistency that no other investment result in modern finance can match. Here is what I want to tell you about the simplicity edge. The simple strategy I am describing is not a single product or a single fund. It is a philosophy. It has 3 components that I want you to understand completely. The first is broad diversification, owning not a single company or a single sector, but the entire market. When you own the entire market, you own every innovation, every transformation, every breakthrough that American business produces over the next 50 years, regardless of which company or which industry produces it. In 1990, nobody could have predicted that the 5 most valuable companies in 2026 would be the ones they are. But someone who owned the entire market in 1990 owned all of them anyway, every single one, because they owned everything. The second component is minimal cost. Every fee, every expense ratio, every trading commission is a permanent compounding drag on your returns. A 1% annual fee sounds trivial. Over 30 years, it destroys nearly 30% of your final wealth. The mathematics of small costs compounded over long time is one of the most underappreciated dangers in personal finance. The third component is the one that costs nothing and pays everything, and that is time. Not market timing, time in the market. The willingness to stay invested through corrections, through recessions, through crises, through every moment when the instinct to exit feels overwhelmingly rational. The exit is the mistake. It is almost always the mistake. Let me close with something I think about often. I have been asked many times what I believe ordinary investors should do. Not sophisticated investors, not institutional investors, ordinary people with jobs, families, mortgages, and retirement accounts that they are trying to grow without dedicating their lives to the study of financial markets. And my answer has been consistent for more than 40 years. Buy a low-cost index fund that tracks the S&P 500. Add to it regularly, regardless of what the market is doing. Do not watch it every day. Do not let the noise of the financial media drive your decisions. And give it time, as much time as you possibly can. This is not a glamorous answer. It does not fill television airtime. It does not require a financial advisor or a subscription service or a trading platform. It requires discipline, patience, and the willingness to be profoundly, deliberately, almost aggressively boring with your money. And boring, in the language of compound interest, is the most exciting word there is. I want you to do something for me. I want you to imagine that you are 78 years old. You are sitting somewhere quiet, and you are looking back at the financial decisions you made during your working years. And you ask yourself one question. Not how much money did I make, but how much money did I cost myself? How much did I pay in fees to professionals who could not match the market? How much did I lose by selling in a panic in 2008 or 2022? How much compounding did I interrupt by moving in and out of the market trying to be clever? How much of my final wealth did I sacrifice on the altar of complexity, sophistication, and the belief that simple could not possibly be enough? That gap between what you earned and what you could have earned with a simple, disciplined, low-cost strategy is the real cost of the complexity trap. It is not paid in a single moment. It is paid slowly, invisibly, across decades, in the quiet erosion of returns that you never see and therefore never mourn. Until you are 78 years old and sitting somewhere quiet and doing the math. I have more money than I will ever use. I have built businesses, held positions, waded through storms that would have ended lesser investors. But the single most important investment advice I have ever given, to my children, to the students who have written to me over the years, to anyone who has ever asked me the question directly, has always been the same. Do not try to beat the market. Own the market. Pay as little as possible to own it, and never, under any circumstance, let fear or impatience talk you into abandoning it. The door to genuine, lasting wealth is not locked. It has never been locked. The key is patience. The cost is almost nothing, and the only thing standing between you and the result that history has already proven is your willingness to do something the financial industry will never tell you is enough. To do nothing, to sit still, to let time do what time does best, turn simplicity into something that looks, after enough years, like brilliance. That is all. Thanks for watching.